Okay, welcome back, everybody. This is another episode of Insider Secrets with Rob Mitchell interview series. We're going to call it that way this time around. It's been a while. It was a long and a good summer break for both of us, I think. And we're gonna get back right on it and keep going with the interviews. I think this is number 11. And let's welcome Rob Mitchell to the interview. Hey, Rob.
Yeah. Hey, Badine. Thanks for having me in, man.
Thank you. So tell me, I know it's been a few months. Tell me all the major keys over the last several months that you've been up to.
Oh boy. I've been traveling a lot. I was about 5 weeks in Las Vegas, doing some training there. I've become a neurolinguistic programming trainer and also doing hypnosis training to teach hypnosis. And then also, of course, I use these materials in teaching people that I work with using these concepts in improving their psychology and their ability as traders and things like this. And so I've devoted a lot of my attention to that. And then I was back for about a week, and I was off to China for 2 weeks. Had a great time there. Was in Beijing for a good part of it, and then also down into Hunan province and Sichuan province, and traveling there. Just awesome experience, life-changing actually. And then I'm off to Sydney for a couple of weeks and a few days, and it's kind of interesting because I'm really a home-oriented person, and so I'm really looking forward to being back home again in the coming year. But then also I have a backlog of things that I'm working on. I have a lot of product and development to help traders, and it actually goes well beyond trading in clearing negative emotions and also manifesting. There will be a course related to clearing negative emotions, and that opens up the way for the future. A lot of people get caught up being in their past a good part of the time, and so the coursework is designed to clear that and open the way for manifesting and creating an abundant future for yourself. So, but more details for that probably in mid to late November, towards the first of the year, somewhere in that time window. So, yeah, looking forward to that.
I think it was Ed Sikota who said everybody gets what they want out of markets.
Yeah, everybody gets what they want out of life. Of course, that's profound wisdom. And kind of behind that is the idea that you already have what you need. I deal with the concept a lot. We call it a negative hallucination. Everybody does it. You're going around the house looking for your keys, and you've been looking for your keys for 45 minutes, and they're right on the table in front of you where you've passed by 3 or 4 times looking for your keys. You can't find your keys anywhere, Well, life is like this too. Everything you need is like right there. I mean, unless you've gone buried 5 levels deep in kind of rejecting the resources that were there for you. But yeah, you get what you need in any given moment to help you to see your keys on the table that have been sitting there all along. It's really, because in retrospect you look back and you go, well, how could I have not seen that? And I was talking about that this morning with our group. You literally spend a day looking at charts. I have tens of thousands of hours looking at charts, and then one day you walk in the office, and of course it's usually has something to do with you're working towards a pattern. You're trying to find something, and you're really focused and working really, really hard, and usually almost to the point of giving up. And then you walk in one morning, and it's like it hits you like a ton of bricks. There's this pattern in front of you that you've been looking at on charts for years, but you never saw it. And this happens. It doesn't happen all the time, but like I said, it's usually associated with a ton of work. But that's what personal development's like that. So I think Ed was right on the money with that.
Hmm. But I mean, also relating to psychological issues where people go to kind of act out unconsciously in the markets.
Absolutely. Yeah. Yeah. Of course. You're you're denying the keys.
Hmm.
And that's why I use the word key, because we all have a key in there and we can turn it anytime we want. But
Hmm. Is that related to, taking off those blinders when, you
it,
can't see something or that's in front of you?
yeah, yeah, you have to take the blinders off. Another thing too, I have this theory, it's just kind of a working theory, that a man's biggest fear is his own potential, because we all just have unlimited potential
Hmm. And it
in
scares
life.
us, or?
Yeah, I think that we're actually afraid at just how powerful we really are.
Hmm.
Yeah, at some level. Because it sure is a lot more comfortable to stay in your comfort zone, or
Hmm.
your box that you live in, and the reality that you've constructed for yourself. And as you attain certain levels of accomplishment, you are able to control your environment more and more, and that gets really comfortable. So why
Does
change?
so does fear of failure interfere with that, the embracement of that potential?
I think fear of failure is an earlier level in your development, that you're afraid of failure, because like our whole, and I'm not bashing anybody here, it's just the way it works. Okay, so you go into school, and they spit out all the facts to you. It's like, okay, Columbus sailed in 1492, sailed the ocean blue. Whoa, okay, yes, Columbus did this, and then you spit it out on the test, and they go, oh look, he knew 1492 is when Columbus sailed the ocean blue. And then you go, well, what on earth could you do with that? It's
Hmm.
like, it's not really a particularly usable piece of information. Maybe if you're a historian, it's like kind of cool, and you could weave some cool stories around it and stuff like that. But you're literally rewarded for spitting out pieces of information. Of
Hmm.
course, as we come into a new information age here, where virtually, um, uh, you can get any, I mean, just about any piece of information that you might have memorized in school, you can just, put it in a search engine, and boom, it's there in your face in like 10 seconds, right? Not
Yes.
even.
Hmm.
It'll go 0.21 seconds, 1.8 million records found. You're like,
Hmm.
whoa, you know. And so the idea that human consciousness is actually not local is really what's happening there.
Hmm.
It's like, and not only that, that certain search engine becomes the consciousness of a society, or the awareness of a society, for example.
Hmm.
So,
Hmm.
you know, it's an interesting thought. And then you're no longer that stuff that you spit out on the test. You then have to start grappling with the realization that you are something way more than that.
Hmm.
And that's what you do in the journey as a trader. But where I think a lot of people get into trouble trading is that you're not right a lot. You know,
Hmm.
and then you have to actually embrace not being right. But you spent you know uh, you know you know 2 decades in school. Um, you spent 2 decades in school being told that right was spitting out the correct answer, and then you come to trading, and it's like, well, you're you actually have to embrace being wrong.
Hmm.
Well, that's a remarkable transition to embrace being, well, and more importantly, to embrace not knowing.
Hmm.
Because you're dealing in the realm of probabilities. So
Hmm.
it's like, okay, you come to a point that you actually have some level of comfort in not knowing.
Hmm.
You know,
Yeah,
what's that?
before you go
What a
into any trade, you have to realize that you don't know what's going to happen
Yeah,
and
and
be okay with it.
yeah, you got to be okay with it.
Hmm.
And then if you start from that premise, then you don't get into a lot of because then the trader gets into the mental trap of self-condemnation, because you have to be right.
Yeah, I think it's amazing how much the losers hurt compared to how good the winners feel?
Yeah, that's an ego thing, and
Mm-hmm.
that's really what we're talking about. Because the ego says, "Oh, yeah, I got the answers right on the test,"
Mm-hmm.
But trading is really not about ego. You kind of have to transcend it somewhat to be successful with it and be comfortable not knowing, be comfortable um, in a state where you're really kind of standing on the edge of a cliff.
Mm-hmm.
And but that's where great things happen. Great things, I mean, if it's a box, right, that you live in, great things don't happen in the middle of the box. They happen out at the edges.
Mm-hmm.
But the edges are also the place where you can get your, you pop your head up above the top of the box, and then this big blade comes swinging by,
Mm-hmm.
right? And it's kind of like, you can make some Greek, you know, uh, myth about it or something,
Mm-hmm.
But great things happen at the edge, And in the grand scheme of things, you don't really lose anything. Everybody makes it through life. One way or another, we all make it through life.
Yes.
So it's kind of like this funny place where you get as a trader. I love that about trading because it's, it's challenging you with who and what, who and what you are.
Mm-hmm. It will show you, yeah.
Yeah, it'll show you who and what you are, and it'll give it to you in the exact dose that you need right now to learn the thing that you need to learn.
So you can get to work.
Yeah, so trading's great, man. Get in there and get at it.
Mm-hmm. Let's shift gears on a technical side. Is it safe to assume that so we know that markets can only do three things: go up, down, or kind of range in the middle. So things like trends and range trading are inherently, how would I say, they're inherently not 100% accurate systems, right? Because all ranges eventually break out and all trends eventually end, right? So, my question to you is, how do you find a balance between knowing when to um, accept that we are in a range and play along with the range, or realizing that I think we're in a trend and start preparing for a trend trade?
A lot of that for us and the way we trade, like intraday, for example, has to do that we know range expansion is more likely during certain times.
Mm-hmm.
For example, we know, like in crude oil, for example, that range expansion is likely the biggest range expansion in 30-minute period of the week is on Wednesday,
Mm-hmm.
following the crude inventory report. So this is one way that you can, by doing range analysis by time or interval,
Mm-hmm.
you can often root out little diamonds there that you can harvest,
Mm-hmm.
or at least that's the period where. Another thing that is that pending reports, and so you can go to a source like Forex Factory, for example.
Mm-hmm.
It'll give you all the reports, all the expected,
Forecasts.
Forecast, but it'll give you people, who's speaking today at what time, and this sort of stuff.
Mm-hmm.
And you want to know when banks or countries, governments, for example, might issue changes in interest rate policies and things of this nature, particularly in the currencies, for example. And so, and of course, these days, crude oil, a lot of commodities, for example, are denominated in dollars, and so movements in currencies affect the dollar. But then when if you go in and you try to, I'm going to jump around in this topic a little bit here for a second. You go in and you try to identify a correlation, for example, between a dollar movement and the underlying commodity movement.
Mm-hmm.
Because if the dollar's going up, and crude's cycling down, if it's trending down, that you could get really big moves right there.
Mm-hmm.
So here's another way that you can kind of know that a trend is happening. If the currency, if the dollar index is going up, for example, puts downward pressure on crude oil, and if the dollar is going up, it'll put downward pressure. They're inversely related, is what I'm getting at here. So if you're cycling, meaning that you're alternating in an upward or downward kind of pattern, A, B, C, D kind of structure, and the dollar is moving consistent with that, you can get quite large moves when that is occurring. Now, really rooting out the exact correlation using traditional correlation formulas is a slippery undertaking at best. But you can often see when those are happening, and they are often happening when the market is trending. Now, the flip side of this coin, of course, is when is the market consolidating? And then there's going to be a third thing I'm going to bring into it, and that is when one of those consolidation morphs into, a trending, and trending morphs into consolidation because the scales are not defined. It's like what is the scale that this, because the question that you're asking presupposes a steady scale, and a big part of trading is that the scale's changing all the time. That's the one that really throws you for a loop. I mean, imagine if you, let's say, you trade, Canadian. What was that one you were showing me earlier? Canadian dollar.
I think it was USD CAD.
Okay, USD CAD. Okay, imagine that by some law of nature, that USD CAD traded every single day exactly 100 pips. Okay. Well, but you didn't know which direction. But you knew it traded 100 pips. Okay. It's like, okay, I know it trades 100 pips. And so when it goes 100 pips, that means it's got to go the other way. It's got no choice. Either that or it's just got to sit there at 100. It's like locked limit up or something. Right? But traders like to trade, and traders are ones that are often moving these markets. So traders will, if it can't go up anymore, they'll go, well, let's take it down. So traders aren't the smartest bunch of people in the world. Me being.
Yeah, we're talking about ourselves.
They're not the sharpest, not always the sharpest tool in the shed. And so, it's like, well, if it won't go up, let's trade it down because let's get some action going on. So they'll trade it down. But I mean, if that scale was locked in to a range every single day, then trading would be a breeze compared to what
it really is.
Yeah, you'd have some level of predictability based on that known range, because you could get into a period, say in USD CAD, where it just moves in this tiny little range for like a week, and it's probably pending some kind of information or something like that. So some of the ways that you can kind of get a bit of a handle on if you're trending or what I call counter trending is just trading, that you want to trade the edges. And I know that you've done a lot of work to find trading in the edges. That you can use some of these kinds of ideas. Pending information is very likely to get consolidation. The currency of the underlying going against is often indicative of trend. The release of a report is often results in a trend. And so if you're if you're pending report or release of information, just be careful. A lot of times it's best just to wait.
Mm-hmm.
And then not only wait to let it do a couple alternations and shake shake the stuff out.
Mm-hmm. Yeah, I notice especially in currencies, a lot of times, we have major news every week. There's all these countries and they're changing the interest rates, or, there's CPIs, and like USD, we have non-farm payroll this week, right? And so a lot of times, a few seconds after the report comes out, you have this spike up and down, and I think that, like you said, all movement in the market is, for the most part, is stop loss. Um, people
Yeah,
getting
it's a
stopped out,
shakeout.
shakeout.
Yeah.
So I think, especially around the news, you have people who first of all, you have all the systems, right? All the programs that are running. They interpret the news and then they make trading decisions. All the automated systems. So they placing trades, right? And then you have all the retail traders who are getting stopped out, or who are getting in on the action because they're just reacting to the news. And then they get stopped out as well. So you almost always get these up and down spikes around major events.
Right.
So it's almost always better than not to just kind of wait to see which direction it's going to take.
Well, one thing that I've been working on, this is a theory that I have, and one of our room members is working on this. I got the data over to him, and he's taking a look at it. What we do is, and so, if you're so inclined, or, as a listener, you're so inclined. Basically, what you do is you take something like a range bar, and, maybe it's a 10 pip range bar, 15, 20 tick range bar, something like this. And then what you do is you map how many of them you get in a row at any given time. So, if you go 10, 10, 10, 10, 10, 10, 10, so 70, 80, 90, 100, whatever it is.
When you say any given time, you mean of the day or in general?
Well, let's say that there's you said, okay, non-farm payrolls, is the first week of every month, right? That's a big player for a lot of stuff. So then I think, retail sales has also moved some stuff. But so if you take that and you do two things, and in Forex you'd have to go use the futures data. I'd pull the futures data for it. What you want to do is you want to look at the volume that's happening inside of those bars. Okay, and then you map out when the volume is above a certain amount. Like, for example, on this chart right here, that yellow line right there where my mouse is hovering right there, that's about normal for this market. About 3,000 contracts, 2,800 contracts per bar on average. That's that yellow one. It's just some form of an average volume, okay? And I'm hovering it there, and it says 20, about 2,500 over here. So what you would do is you'd split that world into two categories. You got volume, because markets trend on low volume. And but qualitatively, that's not entirely true, but in a short frame it is, because the very reason that it's trending is because there are no opposing orders. Okay, if the market's going up really fast, that's those stops and those spikes being hit right after the report, right? Well, the reason it's jumping up there and making this big move is because everybody canceled their orders. The smart guys canceled their orders before the report and said, let's let all these morons get stopped out, and then let a trend kind of get established before we hop on this thing. Or, they might be such big players that they don't even care about that, because they know, they know there's a trade imbalance and there's a certain amount of money coming in, and they can actually hedge against that and stuff like that. I'm talking currencies here, of course. But like if you go over to the futures and you establish what is a normal volume, then the question will become has the trading moved back to normal volume following the report?
Mm-hmm.
It's just a simple, no-brainer kind of a question that, and so then what you do is you take those range bars and you count them. Okay, I got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 in a row before I started going the other way. And then what you do is you ask yourself the question, well, am I more likely to get 10 of those in a row when the volume is above 2,500 or when it's below 2,500? And then you would plot that. You'd plot X versus Y. You'd plot, above 2,500, I get this kind of range expansion, and then below it, I get this kind of range expansion. And then test different levels. It's basically called a scatter plot. You could Google that or whatever. What's a scatter plot in Excel? You just scatter those two data sets against each other and see if there's a linear relationship associated with that. Just throwing out an idea there for you that you could have some fun with.
Oh yeah.
And it's a little research project that even if you had rudimentary Excel skills, you could probably do that in an hour or something like that.
So what happens when the bars get back to normal volume following the report?
Well, then you're in safe land again, because that means that
we're back to normal.
Normal orders are being placed and the order book is present. Because what happens before the report is, and I had to learn this the hard way, and it's funny because I'm like, I can be about as dense as you can try to be yourself. But one day I placed an order before the report, and I was trading some size, and I was also using an OCO order that placed a stop. Well, what happens is everybody cancels their orders before the report, and so when your stop gets hit, it becomes a market order. Just by definition becomes a market order. So what happens is your stop gets hit, and there are no orders to take the other side of the trade. And so you get filled 15, 20 ticks later. And a 15 lost several $1,000s. And then you have a automatic stop that comes in 15 ticks below. Well, because it went bump, 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 bump like this in 10 seconds, there are no orders below it either. So when somebody sells, it jumps back down 15 ticks and stops you out. You lose $5,000 in 30 seconds. Before it even shows up on your screen, actually, you lose $5,000. You're like, what on earth just happened? What?
Learn that lesson.
Well, yeah, there's nobody to take the other side of the trade. It's like you're the dumbest guy in the room, right? And so now I won't place I cancel my orders before the report because I don't want to get caught in this 30, 40, 50.
Well, this happens also right before the close of the market too.
Yeah, well, I'm not so sure about yeah, maybe some guys pulling their orders there, but also you get institutions trading at or about the close because they don't really care so much about the piddly stuff that us intraday traders are.
Well, I'm just saying the book gets lighter towards the the close.
Oh, yeah. And then also you got institutions stepping in and with a bajillion dollars and couldn't give a hoot about the pattern that you're trading. And
they're going to do what they want to do.
Yeah, and so the best this is another thing. This is one of our room members did this graph. I love this graph. Let me just pull it up real quick. Yeah, here you go.
Oh, you got it always on top. Yeah.
Yeah, it's always on top. Let me get rid of that. And then, Okay,
Mhm.
so basically what this one's doing, this is just simple stuff that you can do.
Mhm.
I mean simple, just as simple as you can make it, the better, okay? This basically looks at, these are 30-minute periods, just called A, B, C, D, E,
Mhm.
B. And this is the range of the day.
Mhm.
So this is a mapping to the upside of what a day looks like. Well, this is 80 ticks right here.
Mhm.
So basically, on average, the market moves 80 ticks by F period.
Mhm.
That's a F. That's
Mhm.
a F. There,
Like
let's
midday.
Yeah, midday. It
Mhm.
moves 80 plus ticks by F period
Mhm.
on average.
Mhm.
And then notice that the slope of it kind of comes sloping down.
Mhm. Shallows out.
Well,
Mhm.
would you rather be trading over here where it's moving, or
Mhm.
would you rather get in here where it's going to drift another 20 ticks higher over, you know,
Mhm.
2.5 hours?
Mhm. Mhm.
You 20 ticks in 2.5 hours versus 80 ticks in 2.5 hours.
Mhm.
Well,
Mhm.
which one are you going to choose? Well, trade during this time of the day.
Mhm.
So
Mhm.
this gets back to the same question. Where do you trade? Well, you want a counter trend trade? Okay, trade from the edges in here.
Mhm.
I'm not telling you to do that.
Mhm.
You got to take the analysis down a little bit more. But this is the general tendency.
What is it, about 65% more or something?
Oh, this is 4 times what this is.
Okay, so
This is 80. This is 20.
oh, okay, okay.
This is 4 times the movement in this 2.5 hours is in this movement in
Mm.
this 2.5 hours.
Mm-hmm.
Well, so here's what happens. Here's what novice traders do. Why do I know this? Well, because I've done it. You know,
Mm-hmm.
I can. You feel it, right? Because you've done it so many times. After you've been an idiot so long, you finally accept. Okay, I've been being an idiot, and I'm not in denial that I. Here's what. So here's the pattern. Okay, it's like market goes boom, 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 boom.
Mm-hmm.
80 ticks up, and they go, holy, it's like Malcolm Gladwell wrote one of the greatest trading books ever written. It's called The Tipping.
Mm-hmm.
You got like early responders. These are the guys that come. I forget what
Adopters. Mm-hmm.
your early adapters
Mm-hmm.
or adopt, and then you got I forget what and these are the latecomers.
Mm-hmm. Mm-hmm. They want the
And
action.
these, yeah, and because the latecomers, they're also fearful, which means they have even smaller accounts and they can't handle the alternations that are going to happen to do. I mean, how on earth? Show me a chart that goes 20 ticks or pips in 2.5 hours. It's not going to do it that way.
Mm-hmm.
It's going to go up, 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 stop,
Mm-hmm.
stop, stop out, stop out, stop out, stop out on all these small accounts, right?
Mm-hmm.
Well, so you got to get positioned in here someplace for that, or
Mm-hmm.
you're
Mm-hmm.
dead meat, right?
Right, because you're also gonna invite all the guys who gonna fade this move. So
Yeah,
there's gonna be the.
yeah, yeah.
Mm-hmm.
Because by the time you get here, you're up at yesterday's high or low.
Mm-hmm. Mm-hmm.
You know,
Mm-hmm.
you're up at yesterday's high or low. So what the edge players, the market profile players, they're all going to start fading right in there.
Mm-hmm.
That's why this is a fight, because this doesn't really look like that. What it looks like is this.
Mm-hmm. Yes, just ranging. Mm-hmm.
So you got to be an early adopter, because the probabilities are not only better for you through that, but your entry risk and your entry efficiency for the trade is much better through this period.
Mm-hmm. But
There's
this
about
but this also
50%
means
stack in your
that it can go up and down, 80 ticks in the first half an hour or half a
Well,
day,
yeah, it
right?
could. This isn't the shape of it. This is
Right.
the average.
Mm-hmm.
This is the average.
Right. What I'm saying is it can go down 80 and then up 80, and that would still show up as 80, right?
Well, yes.
Mm-hmm.
Yeah, because it's the range.
Okay. Got it.
Yeah. So that's absolutely correct. And so this isn't a trading system.
Mm-hmm.
This is what happens in what amount of time during the day.
Mm-hmm. No, it's a very useful statistic for sure.
Yeah. Yeah. So then within that framework, it's like, okay, I know I get 80 ticks in the first 2.5 hours. How can I position myself to take advantage of it? Oh, I know I only get 20 ticks in the second 2.5 hours.
Mm-hmm.
How can I schedule a round of golf so that I'm having a good time while these idiots are getting destroyed.
Mhm.
Because they didn't have the intestinal fortitude and the belief in themselves, and they couldn't see their keys on the table.
Mhm.
And so they didn't allow themselves to see the keys until they got right here. You know, it's just making a metaphor for the whole thing.
Mhm.
And so that you can kind of understand it from the humorous viewpoint that it is,
Mhm.
because it's funny, because it's stupid.
Right.
Where they say comedy is truth, right?
Yeah. Yeah.
And the guy's standing up there on the stand-up saying the stupidest stuff you ever heard in your life, and you're laughing, and you're going, "That's the stupidest thing I've ever heard," and I got a bellyache. Yeah, because you've done it. You've done it. I understand that. He's saying stuff that I do.
Yeah, because you can relate, right?
Yeah, and I'm laughing at me somehow, but he's making it possible because I couldn't laugh at me, and so the guy makes $5 million a year for going up on stage and acting like you do.
Exactly.
It's a wonderful world.
I
That's
know.
what my grandma used to say. It's
Uh-huh.
a wonderful life.
All right.
Glad to know ya. That's what grandma used to say.
Uh-huh. So now this range expansion, right? So you can also apply it to, days of week and
Yeah.
weeks of. Have you done weeks of the month?
Oh, dude, I've done everything.
Okay.
Yeah.
Is there same like first and last week of the month higher range?
You can do it in any way.
Okay.
I'll just throw a few of them out there, right? That's what remember we did this cycle vision project. Okay, there's a couple of different ways, but let's presume that the calendar that we use is meaningful, which might be questionable, but let's say, because there are some problems with the calendar, like some months are longer than others. So like, well, what do you do with that? I could make a calendar out of the moon. When the moon gets to the same point, I'll call it a month.
Right.
That's what a month is anyways, a month, right?
Yeah.
So, you've got different times. Okay, then you've got the time of the sun. It's like 365.24 and a bunch of digits, and then you got to make up with a leap year. Couple thousand years, you got to adjust the calendar because it's getting off again. This kind of thing. But let's just say a month, so you got the day of the week. And then you've got the day of the week and month, because different months start on different days. Okay. And then you've got in addition to the kind of free floating one that I just referenced, free floating time, you can also reference time to a key level. For example, I could say, and this is like what the Taylor book method does. It's like, okay, let's go find the lowest low of the last month or 3 months. Let's go find the lowest low of the last 3 months and use that as a reference point for how we're going to analyze. Or if some guys like to do astrology on markets. So like, okay, what is the birth date of this market? I'm going to use that as a reference point. What is the circadian rhythm of this market? It's like, okay, it's got cycles and they seem to fall into this thing. And so you can use anything as a reference point, and that can be fruitful research, actually. But more often than not, I've found that using price reference points where emotional things occur are reference points. And then you can also create a reference point from something like, for example, like you get this low right here, right? So how often, ask yourself the question, how often does the market make a V bottom? Not very often. Well, that's a significant event. Okay. So, when you come back and you visit that V bottom right there, let's see, this is, so, this is probably going to go up. Probably going to go up. Because this is a emotional moment. A lot of guys got really racked in because those latecomers all sold in here, and you get the high volume. So this region in general is like a rejection area. It'll have to fight to get through it because it's like a traffic jam.
Yeah, I call it the pain area. There's a lot of
Yeah,
pain in
yeah,
there.
yeah. It's a good name for it. A pain area. Um,
Pain zone.
you can think of it like a traffic jam. You go out on the highway,
Mhm.
and so it's like this. We talked about it a minute ago with the order book. Is okay. How easy is it going to be for this market to go up and traverse that same area? Real easy. Why? Because they're not going to place orders in here. There's no reference point for a stop because traders like to place their stops near lows or highs. So stops would be up here. They're afraid to trade. And so what does it do? Traverses right back. You get this V bottom. Right? And so, but you could ask yourself the question as a point of reference. You could ask yourself the question, how quickly did it depart from the area? Either in terms of time or angle or whatever. You could also reference that to a report. That's what we were talking about earlier. It's like, okay, I'm going to reference market movement from a report. Okay, instead of analyzing the market from a month, kind of a viewpoint or a regular calendar kind of viewpoint, let's analyze the stock indexes from FOMC to FOMC every 6 weeks, not the minutes, but the meeting. Or you could do both, or whatever combination. Let's reference the market to non-farm payrolls. What does from the non-farm payroll release, what does the market look like in the coming month to the next non-farm payroll release? Does the market tend to depart from that region? Does it tend to come back into it before the next report?
Okay, so what you're saying is looking at the market from the standpoint of not time, but meaningful events that recur.
Meaningful events, yeah. And what are other forms of meaningful events? Well, prior day highs and lows, monthly highs and lows, weekly highs and lows.
Now, in time or in price?
Those would be price.
Okay.
But it's always going to be price because there's going to be the intersection of the price.
Okay.
So, and so what I'm saying is this opens up a whole world. It's like now you're looking at charts and you're going, okay, well, what happened right there? Was that just technical trading? Was that because last crude inventory day for it was crude. We just got a really big movement on that day. The 28th. We got a really, really big movement on that day, and the market's been in a rally ever since. So, every time it comes down, you get into a buy all retracements kind of an environment. Or you get into a sell all rallies environment. And so, now, again, then the question becomes, well, what's the scale that we're dealing with? And the answer is, it's a little slippery. It's a little slippery. So what often ends up happening is there's a couple of different approaches that you could do to it. Either you're going to get into trades trying to pick the top or bottom with really small stops. And yeah, you might not have the biggest win percentage in the world, but you get caught in these big, giant runaway trades with low risk. And that's actually a form of trend trading in the end game, even though it's like you're trading from the edges kind of thing. And that's what I meant earlier. The trend trading and counter trend trading start morphing into one another in different scales. That's why I brought up the issue of scale. Because what appears to be trading from an edge in a larger time frame analysis might be a trend trade.
Yeah, I've noticed this pattern a few times now where you have this V bottom, right? Then you have this rally. Then you have a pullback to, say, a half point or whatever, Fibonacci, whatever there is. Right. And then you have all these early guys, right, that push it up a couple of bars. And then you have that takedown, right? And what usually follows is another rally. But
well, the 50 is a major. That's what this yellow line is. That's the midpoint of the day, right there.
It also looks like a third. It also looks like a third of the whole move. So like a 38.2 or whatever the Fibonacci thing is.
Yeah, one that that we see all the time, if you hit the midpoint from above,
Mm-hmm.
they,
Mm-hmm.
they, we're going to get into conspiracies and stuff. So
Mm-hmm.
they, whoever they is, they'll tend to buy.
Right.
So,
Right.
okay, you go above it, you come down, they buy it.
Mm-hmm.
Come back down, they touch it again, they buy
Right.
it.
And
They come back
so, and
down, touch
then you have that divergence there on that smart momentum on that second dip, right?
Yeah,
Okay.
yeah. So you could look at stuff like that.
Okay.
And so I call these trading away from.
And then what's the blue line, the blue dash line that we went just below the yellow?
That's a VWAP.
Oh, view. Okay.
Yeah, VWAP's another golden number. In
Probably, yeah.
this particular
A
market.
lot of guys look at it, right?
Well, see, that's what you're doing is then you get in. Okay, let's take it one step further. Let's take it from the viewpoint of, well, we know there's different groups of traders participating in the market.
Mm-hmm.
Some of them like market profile, and some of them like to trade from the edge, and some of them, that might be the market profile guys too. Some of them are only want to be trend traders. They only trend trade. Some, those guys will trade like moving averages with big stops and they'll win 22% of the time and still, do okay because they get caught in these big giant trades they stay in for a month, And everybody's trading on these different time frames and all this different stuff. And then you got the Fibonacci players or the halfback players, and you got the Murray math players, and you got the guys doing ratio analysis on the Batman pattern or something, and then it's just like all this stuff. What I do, I make it really simple. I ask myself the question: who participates in this market, and what does what's happening right now mean to them?
Mm-hmm, mm-hmm.
And then I try to position myself where those groups are ultimately going to have to support my trade.
Mm-hmm. Okay, so you're
That's
fading a lot of popular.
it's like you watch poker. It's like, okay, you learn the rules of poker. It's like, okay, you've got you know Texas Hold'em or whatever, right? It's like, okay, you got the cards, they lay them down on the table, and you can kind of root out what's happening based on what's laying on the table. There are certain probabilities as each card comes out, and you can start making assumptions about what the other guy is doing based on his bets and things like this.
Mm-hmm.
But then the real pro players, they're not playing at that level. What they're doing is they're trying to get you to think that they're doing something that they're not so that they can trap you.
Mm-hmm.
And that's why most of trading is really about trapping.
Mm-hmm.
It's really about trapping. And so,
But it's trapping by default, you could say.
Yeah, by definition, they're going to get on the wrong side
Mm-hmm.
because they don't understand the whole thing. And even if you're good, you still get trapped. But you get it to a point where you're not getting trapped all the time, and then you get caught in some big moves, and the big moves greatly outweigh. That's why it's really important to hold on to your winners.
Mm-hmm.
That's why they have the old saying, cut your losses short and let your winners run. Now, of course, in the grand scheme of things, that doesn't really mean anything because you don't cut your losses short. What does that mean? 3 pips?
Mm-hmm.
Well, no, because you use 3 pip stop, you're going to eat it.
Mm-hmm.
But you get stopped out.
Recognizing early that you're wrong, and like for me, what I do is when the market goes right through my order, I immediately know something's wrong. Should not happen. So
yeah, because
right.
Well, and so what are you responding to? Well, you're responding to the idea that a certain group of traders should be defending there or something, and if it goes right through it and they don't, you're going, well, my presumption was probably wrong because I should have seen at least a high volume bar there.
Yeah, I should see some kind of pause, because I like to trade where I have an edge, right? So, but when it goes right through me, something has changed fundamentally or technically. So what I do is there's usually always a pullback, and I move my stop from say 100 ticks down to 20 ticks because now I moved right under that bar under the pullback bar, you could call it,
Because it shouldn't.
because it shouldn't. You shouldn't
Right.
go below it. So, and then I'll get stopped out. So I was wrong on my analysis, and I only got 50 ticks stop loss instead of 100.
Hmm.
So I greatly improved my statistics performance, and that way I'm rarely hit to my original stop loss. It happens very rarely.
Yeah, we talk about that a lot in our group too. Is
Mm-hmm.
that, and I think we've probably talked about it in this series. A stop loss is not a risk,
Mm-hmm.
because if you place the stop with the intent of it being hit,
Then
then
why?
that's what's going to
Yeah,
happen.
why are you trading? Just put
So,
a limit there.
and in 25 years or 27 years of developing trading systems,
Hmm.
I have never seen a stop loss order improve a system ever.
Yeah,
I've
not
never
by
seen it.
much. Yeah,
Yeah.
catastrophic stop. Yes, like out of ordinary type of outside of the range boundaries.
Yeah. But as a general rule, a stop loss is not logic.
Hmm.
It's a stop loss.
Hmm.
So it's relatively meaningless. Another thing that you can do, and it's related to this same question that you've asked, is ask yourself in the market that you're trading, what is random?
Mm.
And you can answer that by asking the flip side of the equation. At what point can I tell when a trend is in place or not? At what point can I tell um, that this, for example, is the low of the day? Or at what point can I tell that this is the high of the day?
So that's where the statistics come in.
Yeah, and it's just simple stuff.
Hmm.
It's like, okay,
Hmm.
um, it's like, okay, if that goes, and you can just do a plot of it, and but this is an extremely valuable type of analysis,
Hmm. Hmm.
because if I know there's a 68% probability that the high of the day is in,
Hmm.
and I can get into the market going short 20 ticks away from that, then I can reasonably place a protected stop. At some point, that movement's going to be like 80%. What do I mean by protected stop? Well, if I know that this is the high of the day was 68%, and I got a stop on the other side of it, then there's approximately a 70% chance that even if the market flops around all day, I'm going to be right.
Hmm. Hmm.
Presuming I can
You can
do that.
probably get even.
Yeah, so and then at that point, the psychology is kind of cool. It's kind of not so cool, because you're going, okay, well, the market just flop around.
Hmm.
Our bond system approach is not unlike that. It'll flop around,
Hmm.
because we get the stop out the edges.
Hmm.
Um, but similarly, we talked a few minutes ago. Okay, it comes to the halfback and it trades away. Well,
Hmm.
okay, that's a protect. The halfback is a protected area.
Hmm.
Almost always, it's
Yes.
going to be protected.
Hmm.
So when it trades away from halfback, you can get your stop on the other side of it.
Hmm.
Put your stop on the other side of it. One of the best places that you can trade is getting your stop on the other side of halfback, or a
Hmm.
key level.
Well, it makes so much sense. You have half the players are on one side of the line, and the other half are on the other half side
Yeah.
of the line.
And so um, that's a decision point. Sometimes I call it a decision point.
Hmm.
And so it's a battleground.
Hmm.
What's another battleground? Well, market gaps up, and it leaves a gap on the day chart.
Hmm.
Um, and so, you come in, you come in at 10 a.m. or whatever. And so the question is, well, one group of traders is saying, well, let's trade it back down and close the gap, because we don't want to leave a big hunking gap on the day
Hmm.
chart. That's not, you know. And then another group of traders is saying, well, yeah, but it traded up to the overnight extreme, so let's take it up there. And so you get into this kind of battleground at that time of the day.
Let me ask something real quick, Rob, about gaps.
That's also the same question, by the way, of is it, is it trying to trade from the edge or is it trying to trend? So,
Let me ask you quick, Rob, about gaps. Is it going down to close the gap because nobody's willing to buy, or are they selling into the gap?
Well, all that started with Larry Williams, 35 years ago or something.
Mm-hmm.
He called it the oops pattern.
Mm-hmm.
The problem, and back in the day, when I first started trading that, it was about 68% that it would close on a given day.
Mm-hmm. On futures.
Okay. Yeah, on most futures markets.
Mm-hmm.
Today, it's like 52, 55.
Pretty random.
Like that. Yeah, so if you gap up, I wouldn't place any assurance on that trade making its way all the way there, unless it was cycling its way there.
Mm-hmm.
But it only covers that about 50% of the time.
Well, the problem is not just with the gap close; it's also the continuation, because so many times it closes the gap and just keeps on going.
Yeah, it can. So you really don't know that piece of information. You don't really know anything at all. You may as well just not know it all.
Okay, so we have just enough time for last topic to keep it around 1 hour. Let me ask you your personal trade management techniques, and I kind of want to compare them to mine. When you get in a trade, what are specific things that you do with your orders? How do you manage an open trade that, say, is a profitable one?
Well, it depends on the market that I'm trading.
Mm-hmm.
In the bonds, I let it flop around, like I was saying.
Let's say oil.
Yeah, in oil, it's a much more active process.
Mm-hmm.
I want to get into a place where I'm trading away from an area before the that expansion occurs that we were looking at.
Mm-hmm.
Where is it? I think I closed it down. And so I want to get into an area that I'm trading away from, or I want to get into an area where I'm trading from the edge, which goes back to your very first question. Because I want the market to trade away from where I'm entering.
Mm-hmm.
And so I want, if it's going away from something like the half point that we were talking about, I know I can get my stop on the other side of it. And like in a case like this, for example, I'll probably get into that trade and only risk $100 a contract. I won't tighten that stop. Generally, I just leave it there. But then what I want to see that do is I want to see it take that prior high out by more than one bar. And so if it starts flopping around following that, I'm probably going to take some off.
So how many times do you normally scale out?
I'll scale out if I think that it's not going.
Well, let's say you get into this like a trend trade for 80 ticks.
Well, let's take this one for example, because I actually took this. Okay. When it came up into the region of these bars over here, and I started getting these tails, I think on this tail right in here I took some off. And then I Well, actually, that one was later in the day, and so I think on that one I took it all off because I was finishing for the day. But the one that had happened earlier in the day, on this particular one, we opened out towards the overnight high, and I bought into this bar here, and then it came up into here. It had taken out the overnight high, and or no, I'm sorry, it had not quite taken out the overnight high, but I got this little divergent pattern here. And when I get the divergent pattern in the red on red, I know it's probably going to go down there. And so I took the better part of it off right here and left some on. And then I added here. And then I took some off up in here when it started flopping around and doing this pattern. In fact, that pattern's a full-out short pattern. That particular pattern is a short pattern. And then I left some on because I expected the range expansion today to be about 100 ticks, and that A low was about 48.63. You can see over in the right margin. So I was expecting 49.63 at that point in the day. And I kept some on. And at that point, I'm on OPM, other people's money. And I actually rode that all the way back down into a break-even trade, which a lot of people would think is insane. I got out over in here. But that was my viewpoint. And the reason that I did that was because 100% of all this garbage over in here was all inside of that run. So and it was all above the halfback. And so from that viewpoint, the trend was up.
Yes.
And I'm at core, I'm a trend trader. And so when this broke down right here, I was like, because this is like bantering back and forth, back and forth, back and forth, right in here. And so, I gave it back. Some guys in the room caught that because it did this particular little pattern. It was kind of a clue in the end. You had some trap traders right in there. That's basically what you have.
How many times do you usually scale out on a good trade?
Almost always scale out.
No, like how many times? Like?
Oh, couple.
Okay. And then do you carry just one stop or multiple stops?
I've never used a complicated stop strategy, but I've seen guys do it.
So just one stop and multiple scale up.
Yeah, but basically, see, what I'm really trying to do, Vadim, is I'm trying to get caught in a runaway.
Right.
And so I'm kind of trading on two levels. I'm trading on a level to get caught in a trade that's going to go like 20 ticks or something, because most of them are like that. And I think in one of the interviews we talked about I call it probability inversion. It was a little table that I brought up. It's in some of the other lectures. But basically it asks the question, how many of these bars do you go before it turns around, which is the same thing we were talking about earlier, doing it on a market on a different scale. But, the answer is, once you go 1, 2, 3, 4, 5 of these, the probability of getting a reversal is probably in the 70s. So it's 70% against continuing right there. So, if it looks like it's losing it and I'm getting a sell pattern, I'm gonna take a bunch of it off. And then what I'm gonna try and have happen is maybe I got a 2 lot or a 1 lot that this is going to run up to 49.63, and I'm going to make like $600-700 times 2. That's what I want to happen. What percentage of the time does that happen? A third, maybe a little less than a third. Just off the top of my head.
Okay, sounds good. Pretty similar to mine. I tend to take some profit off a bit early in the trades so I can move my stop to break even. Helps me psychologically to have a high percent win. and then I let the last 1/3 or 2/3 of the position run to its final target, and I sometimes have a like a middle target, for the second third.
Hmm.
But I'm pretty aggressive with my. I I have 3 stops and 3 scale outs, and so once I take the first third off, then I'm left with 2 stops. I move one of the stops to break even, and then I move the remaining second stop to halfway between my original stop and the entry.
Mm.
And
And that gives you some breathing room on that last leg.
right, even if it turns around on me after the first scale out, at least I'll break even on my second.
Hmm.
I'm not going to lose on that trade. And then there's still some room with that final stop loss for it to turn around.
Hmm.
So, um,
I kind of like this 1/3, 1/3, 1/3 thing that you're doing because, like I said, that how often do you get the runner? Maybe a third of the time.
mhm. Yeah,
You
it's
know.
nice to just kind of get paid when you're right, because so many times you can be right and lose money,
Oh, I do
right?
it all the time. I'm
Yeah.
really good at it.
I mean, yeah, it goes up, 20,
No,
30 ticks
yeah, I
and
told you today.
yeah.
Yeah, no, I got way up. I was up like $500 or something. I
Right.
know what I had there. I gave it all
Right.
back. You might say, well, that was stupid. Well, no, it wasn't, because there was another
Mhm.
50, 60 ticks to go. You know, and I was profitable on these legs as I traded in and out of them.
Mhm.
And
No, that's
it's,
good. You managed it
I thought we
well.
were going 100 ticks.
No, yeah. I mean, it looked like it to me. Like if I blocked this all out, it looks great. A little pullback and then another push.
Yeah,
Always.
we had a condition there. All time frames were up.
Mhm.
Now, what was against it was the dollar.
Dollar was going up hard.
The dollar was going up, and that was against this. And
Mhm.
so when it did that, and we were talking about that in here, and then it did that, I wasn't that surprised.
Mhm.
But because, like I said, because it happened inside of this extension,
Mhm.
100% of all this garbage happened inside of there. And maybe there's a pattern in there that I just don't see or haven't seen,
Yeah,
or
I'll send you a chart of my dollar index, and you'll actually see why it happened. Because none of the other dollar indexes show that resistance that dollar broke through. It actually went up to that resistance level, paused there for like an hour or two, and
Hmm.
then formed this, I call them weak high, right? And then
Hmm.
and then it broke higher, followed by a pullback.
Well, see, this is my chart for the dollar, and at that time, this is exactly what was happening
Okay.
right here.
Okay, good. Yeah, that looks
But
about right.
I'd be interested in
Yeah,
seeing.
but if you put that thing, change it to 60 minutes. I want to see if there's a resistance on the left. You kind of scrunch it a little bit more.
Scrunch it
Yeah,
more.
because see that thing on the left. Yeah, that's what I was talking about. See, so.
Well, now this is a futures contract,
Mhm.
and there are problems associated with that because of the way it might roll the contracts and whatnot.
Right, right.
So it's probably better to use spot data for this chart.
Yeah. Well, but that's what it was doing. It came up to that resistance level. It formed a weak high, broke out, false breakout, and then they took him down.
Hmm. And that was happening at 8 o'clock.
Mhm.
8 o'clock. That high was right here, and that wasn't too far off of. See, so all this kind of happened, not when that high happened, but when this one happened, where I have that little magenta.
Okay, I see.
That sell-off happened inside of here,
Mhm.
and that's what I was saying earlier. You have to be very careful with dollar, crude oil, or commodity
Correlation.
cause and effect
Mhm.
things, because crude oil is trying to do its own thing, but then yet at the same time, big money players, ExxonMobil might be going, well, we need to protect ourselves on this dollar thing, and so they might actually have trading operations that are trying to hedge dollar fluctuations, or currency fluctuations with the crude, and so the relationship, though it's in general inversely related in any given interval, within the framework of a price action, that gets to be a little bit slippery, more than slippery, even. But we watch it. I just keep a chart up. I don't try to make a religion out of it, is what I kind of jokingly call it. Where you just decide, this is my belief system, and therefore the market must comply with my beliefs, or I will lose everything I've got. Darn it. I will lose everything I've got if this belief is proven false. Okay, you will. Because it's always different. One thing I'd say about trading, everything we've discussed, it's always a little different.
It's never...
There's a patterns happen this way and that way.
No, we all want it to be A equals B.
Yeah. You want it to be that thing that goes back to getting it right in school. You kind of want that.
Yeah.
And then after you've been doing it for 25 years, you go, it's never going to be.
Yeah, you're so right. Because in school they're like, if you
like
study,
in there, let's trade.
Yeah, if you study and then you can actually get an A by doing exactly what you were told to do. You can be right.
You can get an A by knowing absolutely nothing.
Yeah, even if you know it, but in school they teach you A equals B, but you cannot take that to market. You have
because it's always going to be kind of this. I heard it. I don't know who said it, but it's probably been said a million times. But good business decisions are made on the basis of incomplete information every time. They're always good business decisions are always made on the basis of incomplete information. Why? Because you have to be, what'd you call it, an early adopter.
So
you have to be.
Comes down to risk.
It comes down to
taking risk.
Positioning yourself. And you know where I got that? I'll just take a second. Who's that guy who ran PIMCO for a long time? He's the biggest bond trader in the world. Brilliant guy. And he's got a lecture. You can probably find it on YouTube. Or it might have been a TED Talk. But, why can't I bring his name up? My cousin always comes down to see him. But he went over to Janus. But anyways, Bill Gross. He's wealthy, and he had the opportunity to be part of over 100 startups. 100 startups. What's a startup? It's the breakout. A startup is a breakout trade, right? So he had his guys, and he's got brilliant analysts at his disposal, go through all the data for 100 startups that he was involved in and lay out for him what were the ones that worked and the ones that didn't. And the number one factor in the analyzing 100 startups that he was involved in, the ones that failed and the ones that worked, the number one factor that made any startup a success was the timing. The timing.
How early they were in the market?
Yeah, let me give you an example. He gave us a very specific example that sticks in my mind. I only see this one time, and it just stuck in my mind. It's a very good thing to know. And if you can find that, like I said, it's either going to be on TED or Bill Gross, 100 Startups or something like that. But he said they had started, and I don't remember what it was called, but they had started the service that people could upload their videos and look at it. You could post your videos. And they were having trouble with it because the internet bandwidth at that time wasn't quite enough to support streaming a video. And so there were technical issues with it. But they had put all these resources into starting this thing up. And they couldn't sustain it any longer. It was no longer economically reasonable for them to continue doing it, and they shut it down. Well, about 2 months before they shut it down, in comes YouTube. And it just so happens that they had developed this technology for compressing the data so that it could get through the pipeline and do the streaming video on everybody's computer. The timing of the technology with the improvements in bandwidth that you could get through your service provider and everything else all lined up right there. And that company was YouTube, and it exploded. Because they were in the right place at the right time, nobody could compete with it. Nothing comes close to YouTube. And it's got just insane amounts of content and everything else. But Bill Gross had actually been involved in a startup that would have been before YouTube, and it would have turned into a multi-billion-dollar undertaking. Had their timing been just a hair later, he said. Just a hair later. It was just a matter of this algorithm and improvements in the service technology to deliver the content. But they had the idea. Everything about it was right. Everything about it was brilliant, except for one thing. It was just a little bit ahead of its time. So you get into the trade a little bit ahead of your time, you get stopped out, and it turns into a big winner.
Yep.
That's why I look for these patterns that are traps, because the trap makes you wait. And then even like these patterns, these ones that I drew on here, they make you wait not only for the trap, but then for the trap itself to get violated. So it's a double, it's a double failure. And due to the nature of the trapping and the order flow and everything else, it forces you to wait. And it's not perfect, but it's a heck of a lot better than anything ever before, because if you don't have good entry efficiency, then you have to have bigger stops.
You know, Rob, I like this because I have two trade patterns that I trade, and what happens is there's a lot of losers where the market just runs over them. But I have also noticed that the winners, almost always the market comes back to the entry price after the initial, purchase, after you get in. So I think it would be kind of interesting to test these particular patterns and these two patterns are actually involved in range trading. And it will be interesting to test.
A lot of this stuff happens at the edges.
Yeah, it will be interesting to test for me actually a different entry technique for these particular patterns, where you enter on, the first entry is, okay, it didn't get run over, great. Let's enter on the test of it.
Well, tell me what. Pick a symbol where it can be matched in the futures, where we have level 2 data.
I mean, you can do perfect 6E.
Yeah, 6E.
Euro dollar.
So yeah, that's fine.
There's an example today, for example. It's a pattern 5A.
All right. Well, send me over where that is. Give me the time within 10 minutes or something like that, and I will. I'll do a little analysis for you and see. But a tremendous percentage of the time, these traps happen right at these edge locations, these same locations that we've been talking about: prior days, high low, probably halfback, departure areas, pivot retags. We have different names, but this is what trading is all about: is these, or you call it an emotional area, and they're trade away from areas, and nothing's more beautiful than catching one like that, because you have nothing. It basically doesn't move against you and just runs. Those are the coolest trades of all, because there's like, how much more right can you be than we call it a 0T trade. It just goes in your favor from the very beginning. And, I mean, if you could hone it down to those are the only kinds of trades that you take.
Well, yeah, that's the thing. I'm usually the first guy in. And I'm usually, right on. But then it tests me.
Well, of course,
Right.
if you're the first guy in, it's going to flop around because it's still a decision point zone.
Yeah. Yeah.
When you're getting in while it's still a decision point zone.
No, I mean, even when it's like, oh, just tap and go, tap and go, and then we run, and then they still test it. They test it a second time, and then they do the final run.
Well, that's the trap of the trap.
Right.
Yeah.
Yeah. Because I'm getting where people are trapped, but then they trap me, or try to.
Yeah, and I know exactly what you're talking about. It's going to look like.
Well, it looks like
Well,
that thing at 8.
it's kind of like that,
Yeah.
and then it comes down and comes back.
Or like at 8 o'clock, 8:06. You buy the halfback at 8:06. To the right. Yeah, right there. That's where I buy. Okay.
Right.
And then they test me right there on the next couple of bars.
Well, just so you know, I mean, when this leg's really long, I call this a scale change. We were talking about scale earlier. You pretty much, when you get a long run like that, you're pretty much gonna get a trap. You're gonna get a trap more often than not, and so that becomes the buy point over in here.
Okay. And you enter on the break of that bar. You don't.
When we get a long leg like that, I'm gonna be telling you, expect a trap. Expect a trap for the long continuation.
Right.
Because these, it came boom, 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 boom. There were no orders. It went boom, 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 right back through it. It's 2 o'clock in the morning. It's the equivalent of it's 2 o'clock in the morning and you're out on the highway. There's no other cars against you right there. Or it's like a bulldozer just came through and cleared all the cars off the road, and then you're going to drive right through it. Something like that. So when you get a move like that, it's like a bulldozer. And then also the stats were supporting an upward move. But and then what's going to happen more often than not is you're going to get this little ABCD kind of thing, and it's usually not going to trap that by too much, and trader's going to get on the wrong side and is going to try and go higher. Now on this particular day, it just flopped around.
Yeah, I would expect that after 8:11 thing right there, that it would just keep going higher.
This is that time of day where it goes 20 ticks for the rest of the day.
Oh, okay.
So what you want to get in here is a deep retracer.
To get a higher.
So that you can get more than 20 ticks out of it. Yeah, something like that.
Gotcha. Awesome. Okay, Rob. Thank you again for another interview.
Yeah,
it's
thank
been
you.
great.
It's been a long time.
Yeah. I think you told me you're going to Australia.
Yeah, I'm going to Sydney for a couple of weeks, and then I should be back around the 25th of October, something like that.
Okay. All right. All right. So we'll probably do another interview after you come back.
Yeah, that'd be awesome. Let's do one like the second week of November or something like that.
Okay. All right.
Or even the first week of November. Or something like that.
Or if there are some good topics, we can maybe do one while you're on a beach in Arizona, in Australia.
I got a pretty heavy schedule.
I bet.
No, working 16-hour days.
Wow. Okay. Well, thank you very much, Rob, again. And
yeah, you too, man.
We will
Thank
talk
you.
to you soon.
All right. Thank you.
Bye-bye.
Bye-bye.